Welcome to This Explainer. Today, we're unpacking a truly historic financial disaster. We are looking at the July 2026 crash of the South Korean stock market, the KOSPI. But, this wasn't just your standard run-of-the-mill market correction. We're going to explore how a very specific, newly introduced niche financial product actually turned what should have been a routine downturn into an absolute catastrophic wealth wipeout for everyday people.
To really wrap our heads around this, we've got to start with the human cost, which was just staggering. Over 360,000 retail investment accounts were forcefully liquidated by brokers in July 2026 alone. Retail investors lost an estimated $38.7 billion. We're talking about billions of dollars of life savings, retirement funds, and future plans completely wiped out in an instant, just evaporating from the system.
And look, this wasn't just some temporary on-paper dip. This was a devastating real-world tragedy where market volatility actively destroyed people's life plans. For example, one 39-year-old office worker put his home-buying funds, 800 million won, into these products, lost a huge chunk of it, and actually had to postpone his wedding. Another 57-year-old withdrew his retirement savings early, hoping to beat basic bank deposit rates, only to lose it all. People were sharing screenshots showing personal losses of up to 21 billion won. It got so severe that the government literally had to step in with emergency measures, rolling out a nationwide debt counseling hotline just to prevent suicides related to the sudden economic hardship. So here is how we're going to break this all down today. First, we'll cover the historic market wipeout, followed by the global macro shocks. Then we'll unpack the leveraged ETF trap, the margin called death spiral, and finally, the government rescue and aftermath. Okay, part one, a historic market wipeout. Let's just take a second to look at the sheer scale of the devastation that hit the South Korean stock market. In what officially became its worst monthly drop on record, the KOSPI index practically went into freefall. It plummeted 23% in a single month. Roughly 250 trillion won in market capitalization was completely erased. The panic was so intense that the market actually triggered 8 separate circuit breakers just trying to halt the selling. But as we'll see, even with those structural guardrails in place, the selling pressure was just overwhelming. Moving to part two. Global shocks and AI doubts. Because to understand how the building collapsed so quickly, we first need to look at the cracks that were forming in the foundation. The initial triggers, they were entirely macroeconomic. It was literally a perfect storm of external pressures. In June, escalations in a US-Iran conflict severely disrupted global stability. Then, by early July, fears started brewing that the massive boom in artificial intelligence might have finally peaked out, and that put massive pressure on tech stocks globally. Following that, in mid-July, a technology shock from China regarding DUV systems directly threatened the dominance of South Korea's semiconductor heavyweights, specifically Samsung Electronics and SK Hynix, which make up a huge portion of the KOSPI. So that first domino was pushed by these very real fundamental fears. Which brings us to part three, the leveraged ETF trap. External shocks alone don't usually cause an unprecedented 23% monthly crash, right? To turn that pressure into a historic disaster, the market needed an accelerator. And that is the core mechanism of our story today. Just a few months prior to this, back in May 2026, regulators introduced a brand new financial product, the single-stock leveraged ETF. These were heavily geared instruments designed to amplify daily gains and losses by 2 times, so 2x. If Samsung goes up 1%, the ETF goes up 2%. The policy goal was actually pretty straightforward. Keep retail investors' capital inside South Korea, and prevent them from fleeing offshore to speculate in the US or Hong Kong. But these products require something called continuous daily portfolio rebalancing. And here is the catch. Because the ETF must mathematically maintain that exact 2x leverage every single day, it creates a highly dangerous, counterintuitive trap during a downturn. It works like this. Step 1, the underlying tech stock price drops due to those global fears we just talked about. Step 2, because the ETF's asset value is shrinking, its leverage ratio accidentally creeps up past that 2x target. So step 3, to fix this and deleverage back to 2x, the ETF fund manager is contractually forced to sell massive blocks of the underlying stock, right as the price is already falling. By design, daily rebalancing forces the funds to buy high and sell low. It turned them into massive algorithmic amplifiers of downward momentum. And institutional short sellers? They knew this was coming. They started front-running these completely predictable close-of-day sales, pushing prices down even further. And that leads us right into part 4, the margin call death spiral. Because when these structural ETF flaws crashed head-on into retail margin debt, the real nightmare began. When this collision happened, the decay was absolutely brutal. While underlying chip stocks definitely took a heavy hit, SK Hynix was down about 15% on the day, its 2x leveraged ETF cratered a staggering 66.6% from its high. In volatile, compounding downward markets, leverage doesn't just double your losses, it drastically accelerates them. As those leveraged ETFs collapsed, retail investors' ammunition was rapidly depleting. Roughly 20 trillion won just vanished from retail margin balances in a single month, falling to 107.1 trillion won. Credit financing dropped by 2 trillion won. Investors were running completely out of cash to cover their highly leveraged positions. And this is where the mathematical death spiral really locks in. Step 1, that algorithmic ETF rebalancing, selling depressed the stock prices. Step 2, because the stock prices fell, retail margin accounts dropped below the required 140% maintenance threshold. Step 3, under South Korea's T+3 settlement rules, brokers automatically executed forced liquidations. They dumped the retail investors' shares at a heavy discount into the pre-market just to recover the debt. Naturally, this massive dumping pushed prices even lower, which triggered the ETF algorithms to sell more, which triggered the next wave of retail margin calls. Everyone was forced to sell at exactly the same time, creating a total stampede for the exits. Jung-Yin Yun over at Fibonacci Asset Management really hit the nail on the head here. They noted that retail investors were treating highly volatile instruments like long-term investments, but as they put it so perfectly, leverage waits for no one. Because these investors bought on margin, they weren't just watching their portfolios dip, they were actively being stripped of their ability to hold on for a recovery. They were forcibly cashed out at the absolute bottom. Finally, part 5, government rescue and aftermath. As you can imagine, the public was demanding answers, with retail investors protesting with funeral wreaths outside the National Assembly. So the government was forced to step in and stop the bleeding. Authorities had to move fast with aggressive countermeasures. They convened highest-level emergency F4 meetings with the top financial regulators. To crack down on the speculation, they capped individual investment in these leveraged ETFs at 20% of a portfolio. They also immediately tripled the minimum cash deposit requirement, jumping from 10 million won to 30 million won just to be allowed to trade these products. On top of that, they explored adopting a variable leverage structure, similar to what Hong Kong uses, which would allow regulators to dynamically drop the leverage from 2x down to 1x during emergencies to halt that algorithmic forced selling. Naturally, this whole crisis became deeply political. Lawmakers from both sides of the aisle blasted the regulators, accusing them of turning the stock market into a speculative gambling table and basically creating a man-made disaster. This actually led to a rare, formal apology from Finance Minister Koo Yoon-chol right in the National Assembly, acknowledging that these products were introduced without carefully anticipating the systemic risks they posed to the broader market.
But here is the profound, truly tragic irony of this entire situation. Shortly after the regulations kicked in and the selling pressure finally exhausted itself, the market rebounded. Samsung and SK Hynix eventually surged up to 30% in massive daily gains, setting new records. The KOSPI recovered. But for the everyday retail investors, well, over 360,000 of their accounts were already wiped out. Because they were forcibly liquidated during the margin calls, their losses were locked in permanently. They were entirely excluded from the recovery. So it leaves us with a critical, provocative question to ponder. In the constant push to capture capital and offer advanced financial products, when financial innovation turns the stock market into a casino, who really pays the price? As we saw in South Korea, the underlying market eventually healed, but the financial lives of hundreds of thousands of everyday people were permanently altered. Thanks for joining me on this explainer, and I really hope this deep dive helps you better understand the hidden mechanics of market leverage.